In this video, I'm going to explore whether it's better to invest or pay down debt with any extra money that isn't going to cover costs of living. Now, if you just came for the conclusion, my position is that it's important to find a balance between the two, with the cash allocation depending on each individual's risk tolerance. And to be clear, any high-interest consumer debt, like credit card debt or high-interest car payments, should absolutely be prioritized over investing. But when it comes to low-interest debt like student loans or mortgage payments, I think that sometimes it can be better to allocate extra money towards investing where the earned interest rate is likely to be higher. In those cases, I think that debt can actually be a useful tool that allows people to make investments they wouldn't otherwise have been able to make in things like their education or in real estate. And I certainly don't agree with some of the more extreme views out there, like that of Dave Ramsey, a really popular personal finance YouTuber who equates debt with slavery.
The borrower's slave to the lender. You tell me, are you a slave or not? Slaves don't have choices. Other people tell them what to do. Their life is owned by someone else.
Dave Ramsey has a huge following on YouTube, but I think he's wrong about debt. And I definitely don't believe that paying down debt should always be prioritized over investing, because that's not necessarily going to lead to the optimal allocation of your extra money where you're most likely to earn the highest rate of return. But let's dial it back just a little bit. One big question that's arisen in my life recently is, at the end of the month, once I've covered all of my costs of living and I have some extra cash, what do I do with it? Do I take that money and pay down debt, or do I invest with it? I don't have enough money to do both at the same time, and finding the right balance is hard. Part of me wants to just aggressively pay down my debt so I can achieve that psychologically freeing feeling of being debt-free. But the rational interest rate calculating part of me knows that that's not necessarily going to optimize my rate of return, especially when interest rates are so low as a result of the pandemic and all of the stimulus. And when I look at my outstanding debt, which is mainly student loans and a mortgage, my student loan interest rate is 2.45% and my mortgage interest rate is 2%. And those are extremely low, especially when you compare that to the rate of return of the S&P 500, for instance, in 2020, which was over 16%. With such a discrepancy in the interest rates that I would earn by paying down my debt on the one hand or investing in the stock market on the other, it's clear that in 2020 I should have taken all of my extra capital and put it towards investing and put none of it towards paying down the debt. I didn't quite do that though. Sure, the perfectly rational approach to optimizing my allocation of extra capital would be to examine and compare the interest rates of paying down debt versus the likely interest rates that I could earn by investing, and then simply allocating all of my excess capital towards its most efficient use. But that perfectly rational approach doesn't work in real life because of uncertainty. And uncertainty is why I didn't allocate 100% of my extra money towards investing. I mean, sure, in retrospect, I can look back and say the S&P 500 was up 16% in 2020. But when it was actually happening, nobody knew for sure what was going to be the result. The price of an index fund or of an individual stock could go up or down at any moment. And you can't really guarantee that a company is going to continue paying its dividends. But when you pay off debt, you can guarantee and lock in the rate of return, which is the interest rate on that debt. And so that has to be factored into your mental math. And it all depends on how risk tolerant you are. And so in my circumstance, I actually allocated probably 1/3 of my extra money towards paying down debt and locked in that rate of return on 1/3 of my extra money. And I took the rest and I put it towards investing. And I took that approach because I think I'm actually relatively risk tolerant. And if you've seen my video breaking down what's in my crypto portfolio, you'll probably know that I am quite risk tolerant. But that approach is not for everybody. At the end of the day, aside from these purely rational interest rate comparisons, there's a huge psychological factor that has to be accounted for. And if you're not a person that's comfortable living with debt, if the idea of waking up in the morning and knowing that you have a debt hanging over you is going to cause you stress and anxiety on a daily basis, then maybe the best approach is to allocate more money towards paying down debt, even if it's not the optimal allocation for rate of return. But for people that are comfortable living with debt and learn to use it to their advantage, I think it can be a very powerful tool. That's all for today. Thanks so much for watching, and if you enjoyed it and want to see more of this type of content, please don't forget to hit subscribe. See you later.